How to read an Equifax report. Business credit is credit which is in a business's name. It is not tied to the owner's creditworthiness or social security number. Instead, business credit scores depend on how well a company can pay its bills. Consumer and business credit scores can vary dramatically. There are 3 large business credit reporting agencies: Dun & Bradstreet, Experian, and Equifax. There is also a FICO SBSS business score. Equifax gets its data from a data sharing agreement with the Small Business Exchange and Net 30 type industry trade credit information from a wide variety of suppliers that provide products and services to businesses on an invoice basis. Equifax combines financial data with industry trade credit data. They add in utility and telephone data and public record information, such as bankruptcies, judgments, and tax liens. The first section, just below the date, is devoted to identifying information about your company, including the business name, address and telephone number, whether a business is incorporated, and the date you first went into business. This section will also include the number of employees and annual sales, and it will also show if there are any alerts. The next section has 2 scores, the Small Business Credit Risk Score for suppliers and the Business Failure Risk Score. With the credit risk score, 90 or better means paid as agreed, 80 to 89 means 1 to 30 days overdue, 60 to 79 means 31 to 60 days overdue, and 40 to 59 means 61 to 90 days overdue. 20 to 39 means 91 to 120 days overdue, and 1 to 19 means 120 plus days overdue. With the Business Failure Risk Score, 497 to 816 means there's a 25% or less chance of payment being overdue. 452 to 496 means there's a 26 to 50% chance of payment going overdue. 415 to 451 means there's a 51 to 74% chance of delinquent payments. And 101 to 414 means there's a 75 to 100% chance of delinquent payments. Public records include bankruptcies, judgments, and liens. They also show the amounts, if any, and the date or dates the most recent filing dates. This section also shows how these matters were satisfied, such as if a lien was paid off. The next part is a pie chart showing your company's credit usage. It graphically shows which % of your available credit line you are using. It also has identifying labels to show how much each percentage truly is. This is your credit utilization rate. In the summary section, the report shows the number of your business's credit accounts, the date these credit accounts became active, any amounts past due, your most severe status within the last 24 months. This is how slowly you have paid off your debts. The single highest amount of credit extended, the median balance, and the average open balance. All of these factors are divided into financial and non-financial categories. Your company's recent activity is also listed. This includes the number of new accounts opened, delinquent accounts, the number of inquiries, and the number of updated accounts. This section also includes a line graph. It represents a trend line showing your company's average days beyond terms by date reported. This is for non-financial accounts only. The report will point out the recent trend. It adds how many days, if any, your company is behind terms. This section also shows your business's payment index, and it compares it to your company's industry. Next is the financial account highlights portion. This section contains details for the most recent 36 months. It starts with highlights and then goes into detail. It adds basic information on financial accounts such as commercial credit cards and leases, showing status, open and close dates, original and current credit limits, balance, past due amount, if any, and your company's 24-month history. The details subsection expands on the highlights portion. It adds information such as the payment amount and frequency. It also includes whether or not a debt is secured. Secured versus unsecured credit matters a great deal in the event of a bankruptcy. Secured creditors get a preferred place in line for limited assets. Next up is financial account payment details. This next part shows balances, past due amounts, aging categories, and the dates of first delinquency, if any, for the most recent 12-month period. The next part is non-financial payment credit experiences and status. The following section shows trade accounts and the like. It also includes balances, aging categories, and a 24-month history. Next up are public records. This section shows more detailed information on judgment, liens, and bankruptcies. Now for the decisioning details portion. The next part shows the details of what went into your business failure risk summary report. These details will be specific to each business. The final piece of the report is additional information. It shows any DBA information and any related files. It also has any other more or less miscellaneous information which may be in a report. This includes comments which don't fit anywhere else. Let's look at improving your Equifax report. Now that you know what goes into it, you can see that some of the more important pieces of data Equifax looks into are public records, credit usage, and how you handle your financial and non-financial accounts. Improve your Equifax score by clearing your debts as quickly as possible and not going delinquent. Keeping your credit utilization within reason. It should be less than 30% of total available credit is best. And avoiding late payments. Let's briefly talk about the Equifax data breach. The 2017 data breach affected millions of Americans. In light of the breach, you may want to freeze your credit. Knowing how to read an Equifax report can help. You'll be able to spot trends and issues before they get worse. Let's recap. Equifax gets its data from a variety of sources. It includes public records and scoring details in its reports. Its reports focus on recent trends. These trends include payment history and balances. Contact us today to learn more about how to read an Equifax report.